Hi, my name is Sofiia Moshina, and today we're going to talk about mastering risk management and exactly about hedging strategies. So let's begin. Today, our table of content consists of what is hedging, why is it important, common strategies, and real world examples. Also, risk and limitation in this area, and then conclusion. So, I will begin by explaining what is actually hedging. So, hedging is the practice of reducing risk by taking an offsetting position in a related asset. So what I want to say that it is similar to buying an insurance, so means protecting against potential losses in an investment. So how it works, if an investor holds a long position in a stock and they may hedge by shorting a similar stock or buying a put option. So this way, if the stock price drops, the hedge minimizes losses. So hedging does not eliminate risk but reduce its impact. I would say that why is hedging important? First of all, it reduces risks. It helps protect investments from unexpected market fluctuation, actually, and also commonly used in volatile markets like stocks, forex, crypto, commodities. Also, second one is portfolio stability. So it reduces overall portfolio exposure to risks, and also it ensures smoother returns over time. And I would say also protection against market shocks. And global events like recession, political instability, or inflation can affect asset prices. And also hedging shields against system risks. So both individual investors and large institutions like hedge um, to maintain financial security. Then types of hedging strategies. And first, it's hedging with derivatives. Options, investors use put options to protect against stock prices declines. Also, future contracts, like they are used by commodity traders to hedge against price changes. Like I would say, example can be oil, wheat, and then hedging with assets, diversification. Um, Holding different asset classes like stocks, bonds, gold, crypto, or others to spread risk. Example can be that gold often rises when stock falls and making it a good hedge. Then currency hedging. They are used by international investors to protect against exchange rate fluctuation. So, as my example can be that a US investor holding European stock may use currency futures to hedge against a weak euro. And also, the last one, it can be interest rate hedging, when businesses hedge interest rate risk using swaps or bonds, for example. An example can be that a company with floating rate debt may use an interest rate swap to lock in fixed rates. And actually, different hedging strategies are used depending on the asset type and risk exposure. So now I'm gonna talk about examples of hedging, and here you can see some explanations. And also, example one is stock market hedging with put option. When investors own like hundreds of shares of Tesla, but fears a short-term price drop, they buy put option to sell Tesla at a predetermined price, limiting potential losses. Second example can be that commodity hedging in oil markets. Like, for example, airlines hedge fuel prices using futures contracts, and they are using this to stabilize fuel costs. If oil prices rise, their hedge offsets the increased costs. And third example that I can provide is currency hedging in global trade. A US exporter who's selling goods to Europe hedge against a weaker euro using currency futures. So this actually prevents losses if euro depreciates against the dollar. And I would like to conclude that hedging is really widely used across industries, and it helps to mitigate financial risks overall. So hedging risk and limitation. Actually, cost of hedging is like options and futures contracts. They have fees that may reduce overall returns. And then potential profit limitations, like hedging reduces losses but also limits potential gains. An example can be if a stock price rises after buying put options, the hedge becomes really unnecessary. Um, the third one is the complexity of some strategies. For example, some hedging instruments require advanced knowledge, like derivatives or swaps. And last one I would like to mention is imperfect hedging. No hedge is 100% effective, and some risks may still exist, but hedging requires careful strategy selection and cost benefit analysis. In conclusion, I would like to say that hedging is a vital tool for managing financial risks, but also strategies include options, futures, diversification, and currency hedging. Throughout, effective hedging comes with costs and trade-offs, but successful investors balance risk and rewards using hedging only when necessary. So thank you. That was it for today.